Hey, welcome to the podcast, everybody. Thank you for joining me. Hope you had a great weekend. I'll just apologize in advance here for my congestion remains, so I'll try to keep the coughing, grunting, clearing my throat to a minimum. Well, before we get started, just a reminder, karleggers.com. You can get a free subscription there, all the blog articles, the podcasts, and so forth. Google+, Facebook, we're on twitter.com/karleggers, and then eggerscapital.com is the money management website. Well, let's get right to it. The markets a little bit green today, but overall pretty ho-hum day. Of course, Veterans Day was yesterday, celebrated today on the markets. This is one of those goofy days where the bond market's closed, stock market's open. I don't know why they do that. I would have preferred to have the day off, I guess, and the stock market be closed. But put it out on Twitter yesterday, but thank you very much for all you veterans that do follow the podcast and the blog, and thank you for your service. Well, the bond market was closed, so you did tend to see some kind of a, I guess the best way to put it would be an asterisk next to today. But in general, the Dow Jones finished up 2 points. You can see the S&P up less than 1 point. Financials up just a little bit. Russell 2000. Everything was pretty much flat. The only standouts on the screen really are, well, three things. Transports up almost 1%. Utilities down almost 1%. And volatility down almost 10%, down to 16.82. You'd expect volatility dropping that much. We would have a big spike in the markets. Didn't see that today. And then, of course, treasuries didn't move because they weren't open today. Let's go ahead and start off with the S&P 500. First off, got a chart going back a couple of years here, and you can see I've drawn a few little trend lines here as things are getting more and more narrow, and we're at the lower end of the range, so very simplistic to say, well, we should bounce off of this because, well, it just fits the pattern. Not only that, but we have the 200-day moving average right around this area as well, sitting today at 1381, and here we are at 1380, so right at the 200-day moving average. We also have the Fibonacci retracement lines, and again, for those that are new to the podcast, you know, this is some common technical jargon, I guess we'll call it, but basically shows, and there's typical places where the market will pull back from a low to a high. 38.2 is kind of a common one, and then 50%. So that's saying it's given back 50% of the gains. Where would that level be? Coincidentally, right where we are right now. So somebody emailed me over the weekend and said, hey, are we getting close to a spot where we would buy some and use some of our cash up to buy? And actually, the answer is, yeah, we're getting closer, of course, and this is not a bad spot to take a stab at something if you're way underinvested. If you're already fully invested where you want to be, you know, given the circumstances of the fiscal cliff and so forth, then you have to wait till the market confirms and turns around. If you're somebody that has a lot of cash and you're actually looking to put money to work, then what you want to do is buy at various levels on the way down, and this certainly is one of those levels. I mean, again, the 50% retracement, the 200-day moving average, it all makes sense. Having said that, though, it doesn't look like we're getting the enthusiasm that you would expect to turn this around. And I would say enthusiasm, you want to see the broad-based buying on top of that. And remember, we had 3 days ago after the election, 3 trading days ago on November 7th, we had that big down day. 90% of the volume was down. And usually after those days, you tend to get a bounce sideways, something up a little bit. And the key is to see, are you going to get any real sustainable buying? We haven't had that yet. In fact, we had another down day on November 8th. And then on Friday, of course, we had a big up. And then when John Boehner, President Obama, got on TV and basically were jockeying for position on how they would come into these negotiations, the market sold off immediately and pretty much was flat on the day, kind of like it was today. So what we're really wanted to see, to be honest, is a little more of a washout. And as painful as that is, if you own stocks, it's what we need to get a more predictable bottom, because we're at the point right now where many of the indicators that I watch that swing from oversold, they call it, meaning there's nobody left to sell and it's overdone, to overbought, meaning there's nobody left to buy, everybody that wanted in is in. That pendulum swinging, like a pendulum on a clock, I would say is 70 to 80% of the way there on the downside, which is good. We're getting there, but we're not quite there yet, and where we have everything line up. I have about, I would say, 10 different indicators that I look at on a short-term basis. Of course, I've got probably hundreds I look at on a longer-term basis, and I've got some on intraday basis and so forth, and hourly, goes on and on. Some of these that I look at on a shorter-term basis aren't quite there yet. They're still in the neutral zone. Yes, if we were to break it up into the quartiles, they would be in that between 50 and 75% level. So they're in that third quartile where it's getting close, but there's not quite an easy entry point yet. But again, if you have some cash, this isn't a bad spot to take a stab at a few things. One of the things that I bought on Friday was biotech, and I used XBI, but biotech is an interesting area right now. And I bought this, by the way, and this is important to understand the distinction between this. This is not a long-term fundamental buy. I could probably argue that. I could probably say, here's the reasons why. It's recession-proof, and there's parts of it that may benefit from Obamacare. I could go on and on about that. What I looked for was an area that had been leading, and then all of a sudden has gone through a correction, and now in the last few days is showing signs of life and is starting to outperform the markets. XBI, which is biotech. There's also IBB. Be careful when you're using these exchange-traded funds, because look what the makeup is of these funds. A lot of these funds are very concentrated in maybe 3 or 4 stocks. They may own more, but they're very concentrated. XBI, a little more balanced, I would say. So that's the one I use. But again, I bought it for a trade, not for a long-term move. So from that standpoint, I kind of put that in my aggressive area of the portfolio that I'm basically looking for a shorter-term move, not something I plan on holding for 6 months. It would be great if I could. It's not really what I'm looking for. I'm looking for more of a reversion to the mean, where maybe this thing gets back up to a level, maybe this 50-day moving average a little higher, and it could roll over again. But what we started to see was some of the momentum slow down on the way. And so when I saw that reversal on Friday, we went in and bought that, because not only did it make a new low in the morning, but it covered all of that up and actually went up to the top. Didn't quite close at the top, but very close to it. So you're seeing biotech get a nice pop, and up 1.5% today in a market that was flat. Again, that outperformance is starting to take over. And remember, it had been underperforming. Yes, the S&P was going down, but biotech was going down faster as people were taking profits from the money they had made in the previous few months. So you saw some of the indicators I watched started to, not make new lows, even though the price of the stock or the ETF was, and that's an important positive divergence. And so biotech looks good to me. And again, all these things are taken with a grain of salt, simply because of this fiscal cliff, and things could stay very, very volatile over the next few days. And so things are gyrating all over the place. But again, if you're wanting to keep some in the market, this is a place I think that looks really good right now. And again, it does make sense that, hey, this is a non-cyclical area. It's an area that doesn't pay dividends, and you may be seeing a rotation out of dividend-paying stocks into non-dividend paying stocks. And again, recession-proof. So when you put all that together, and it's oversold, by the way. We had a nice little sell-off. I think the high was up here at almost $97 a share, and it came all the way down to 81. So that's a nice, 15% sell-off, and now we are seeing it turn the corner. So with some of those things, you might want to put stops. Again, there are certain things in the portfolio for those that have been listening to the podcast. I segment my portfolios and my strategies, because I'm not a one-trick pony, because I don't have the answer. And I don't think anybody else has the answer, meaning they only buy undervalued stocks, or they only buy outperforming sectors or stocks, or they only buy momentum or charts or fundamentals. I think you have to use a little bit of all of that. And on something like this is more of a trade, not something we're buying for deep value, and not something we're buying for income. But we do need to notice what's going on right now, which is there's a rotation, and it could be temporarily, out of dividend-paying stocks and some of those things that have been working. And a lot of it's coming out of the market, but you are seeing some of it rotate into different areas like biotech. And just remember, biotech is a volatile area, depending on various companies inside of that index or that basket getting approval or not getting approval for different phases along the way. And so it's in a more aggressive trade. So if you're somebody that's a little more conservative, just skip it and wait. Now, a couple of areas that got my attention today, utilities obviously have been in the news lately. Utilities were looking really good, and we talked about on the podcast back in September. It was starting to bottom, and that was a good little trade. It popped way up there. And since then, Hurricane Sandy came out, and the utilities are getting a lot of negative press right now because of the how long it's taking to get power back to certain places in the New York area. And because of that, these utility companies aren't getting to sell power, right? Because the power's not on, and thousands of homes, and they're talking about going and have to inspect these homes, 300,000 homes they have to inspect one by one. It's just crazy. So what that means is you'll probably see, and this always happens, you'll probably see some regulation changes and more regulation, and they have to change the way they do things because of one storm, right? We've been through this before with other storms, but because it impacted New York in this concentrated area, and there's a lot of people suffering right now, there may be regulation changes. So you had that, in addition to the fact that you had President Obama get reelected, and we know that part of his budget is to triple the dividend tax. And when that happens, if it happens, all of a sudden, the 4.4% yield on utilities isn't as attractive anymore because you have to pay more taxes on it. So you're having a kind of a double whammy for utilities. With that said, again, you have to decide, is this a trade or is this an investment? I've owned utilities for a long, long time because we've been in this lethargic economy. We're getting income and being in things that people had to buy, right? Utilities, power, as opposed to things that they don't have to buy, kind of made sense. And so I'm still in utilities, and it's been a painful 3 or 4 days, but taken in context here, this thing has been you can see this going all the way back to 2009, very, very steady, and this is just a brief sell-off, I think. But let's take a look at this. What we have now is this is very, very oversold for many reasons, and I could bring up 7 different, 10 different indicators showing it's very lopsided. And I've drawn this kind of support line because I think this is the first area of support is going back here to April, which is kind of in this, we'll call it 34.19 area, 34.20, which we're very close to it right now. So many of these indicators are very oversold. So I would say the same thing. You've heard me say this numerous times over the years. If you're wanting to sell a position that's losing you money all of a sudden, and we're still up on utilities quite a bit, but it's in the last 3 or 4 days it's lost a lot of momentum. What I would say is if you're wanting to sell it, you will have a better prices to do so in the next few days, I believe, because what you're having is a kind of a washout. You can see it. The volume's picking up, and I'll make the volume a little bigger here so you can see it. The volume's picking up. You can see this is a 50-day moving average of volume. If I change it to a 20-day moving average, you can see it picking up here. So the volume's picking up. People are getting out of utilities. It could last, but I think in the short term, we're looking for a pop. Now, when it happens, and somebody asked me today, does that mean you're going to sell at some point, maybe higher prices? And the answer is, I don't know yet. What I would tell you is that if it rallies and it's outperforming the market, the S&P, let's call it, and we see a rotation into that area, then we would be inclined to keep it. On the other hand, if it bounces up, maybe comes back up to, let's say it adds on $1, about 3%, and then it starts to roll over again, and the rally was on low volume, and it was underperforming the market, then that would be a time to go ahead and sell now that it worked off of the oversold condition. So, if it bounces up to here and it starts to roll over again, then you may want to exit the position. Yes, it's a 4.4% yield on XLU. That's a great yield. And it's still an area I think makes a lot of sense in this slow, lethargic economy. But we can't deny the fact that there's money flowing out of it. Our job is to find where is it going. Now, one of the other areas that has been seeing some money coming out recently, and I think this is probably even a bigger opportunity for us, is the oil and gas pipeline companies. Okay, these MLPs right now, that income's sheltered. They're set up as partnerships. I don't know if a lot of people don't understand it, but they are being sold because they have high income as well, right? They pay 4, 5, 6, 7% income dividend yields, I shouldn't say dividend yields. Let's just call them yields because it's not dividends you're getting paid. But I think that's the misconception is that people think, well, it's income. I need to go and sell it because I'm going to get taxed more on it. Not necessarily. Now, there is some regulation that could change this, but from what we've been seeing from some of the big institutions is that that's a low probability deal. But what you might have is 75% of these partnerships are generally owned by the retail client, not by the institutional client. So what that means is there's a lot of retail investors, average people that have their accounts at Fidelity, TD Ameritrade, Schwab, E-Trade. Those people that own those hear that you're going to be taxed more on your income, and they start selling this stuff. But if you go through some of these, New Star Energy, this is a San Antonio-based company, 10% yield, just getting hit really hard. Sunoco, Logistics, Magellan. I'm going in order of how hard they were hit today. So these aren't the biggest ones necessarily. As you can see the charts, and let me zoom in a little bit. you can see the big drops. Plains All American, 5% yield, down 3% today. Big heavy volume. It just goes on and on here as we go down the list. Atlas Pipeline, Martin Midstream, Kinder Morgan. So now if we sort them by, and I show you some of these based on market cap, you'll see some of them held up okay today. Companies like Enbridge held up okay. Spectra Energy held up okay. Energy Transfer Partners held up okay today. But for the most part, as a basket, a lot of them got hit pretty hard. There's Kinder Morgan. This is probably the best one, the biggest one, and one that I've owned for years and years. And you can see it's getting hit pretty hard. But if we go back again for years, you look at this has been just a dominant company, 6.3% yield, and it's continued up. This is a little blip on the map. Now, at some point, could they change the way these are taxed? Absolutely. That's pass-through securities. They could change that. And that's what the market's trying to figure out right now. Volume's going up. But I think ultimately, remember, this is an inflation hedge. You get a lot of income with it. Treasuries can't compete with it, even if they were taxed a little more. And that's a low probability that's going to happen. So when you combine all those factors, I think this is going to be an opportunity. And right now, a lot of these, if you look at some of these, they're trading, they're going down at such a fast rate. And it's not like they're going down 10% a day. But, when you start talking about their trajectory, which they're going down, it's very, very abnormal given their volatility in the past. And so they're going to get a bounce as well. And again, what's happened is you're seeing the retail investor flush out of these. So, and oftentimes retail investors are the last to sell, and they're quite frankly incorrect. So watch these, and this is an area that I think could be a something to buy the dip is going to be some of these. So I wouldn't bail on these just yet because again, there are plenty of other things that are probably going to get changed tax-wise. I don't know if this is going to be one of them because this is this is how a lot of deals are funded. These types of companies, raise money all the time from investors, and that's what gets these deals done. I don't see this changing, and yet the market is pricing it as if things are going to change tomorrow, and I don't think they will. Now, as I mentioned earlier, the volatility index, the VIX, is down over 10% today, and again, you would expect, given that the market would really had a nice day, and it wasn't. It was fairly flat to really down most of the day. So VIX, you can see going back here, had that spike up around in the mid-20s back in May and June during that sell-off, and here we are during this sell-off, and we're at 16. So that's got some people concerned. On the other hand, they're voting with their money. And if they're so concerned, why is it holding back? So that's something that we're watching. I don't necessarily have the answer, but I do know that what tends to happen is how fast this volatility index goes up. It tells you how much panic there is. Not necessarily the level, but the rate of change, how fast it's going up. And it's not going up very fast right now. So again, it's not to that point where we would say there's overall panic, we need to do something and jump in there and buy a bunch of these bargains. So the market could bounce over the next few days, but I think ultimately we may go a little bit lower before we get a nice, good bottom. And in the bigger picture here, the thing we have to be concerned about is that this is an aging bull market. Okay, when we go back, several years, what we find is that this stock market, and I'll go back to 2008 and 9, you can see the ultimate high back here was around 1550, 1560 on the S&P back in '07. A lot of people felt like this round, this move, we would get up to that. Now that's all being questioned because of the fiscal cliff, who's president, all those types of things. But the thing is, bull markets tend to last about 3 years. We'll call it 36 months. And if you do a little math here, you'll figure out that we're past that. We're probably 43, 44, 45 months into this from this point. And so it's an old bull market. The bull market that started in early '09 is old. It appears to maybe be getting tired, we'll call it. The volume is very low. We've got all these issues to deal with. But here's the good news. The good news is it's not showing signs, and this can always change, but it's not showing signs currently of a market that's ready to roll over for good. When you look at the companies making new highs, and you look at the companies that are going up versus going down, all those things, when you look at the upside and downside volume, all the internals, we'll call it, as I usually say, those aren't saying that this is a bull market about to become a bear market tomorrow. It's just not saying it has a few more months to run. So it is possible that we get oversold here, we make one more push up, and then it's time to go really defensive where you are actually selling the rips, so to speak, and shorting and holding those positions for a while and benefiting from the fall. I don't necessarily see that right now, but we have to take that with a grain of salt because we're not in 2009 where this is a fresh bull market. We're in an old bull market. So you have these two things competing with each other, and that's why it's all about time frames. One other thing to consider is when we strip out the closed-end funds, some of the REITs, when we strip out all the things that aren't real operating companies selling widgets to one another and to consumers, when we take those out of the New York Stock Exchange, you're left with just the operating companies. Those companies, when you look at how many stocks are going up versus down, it isn't as compelling of a picture. So again, we have to, weigh all of these things when we're taking this into consideration. And if I was so convinced that this bull market was going to continue on for several more months, I would be positioned very, very differently. But as it is right now, I'm positioned in a pretty conservative manner. Still on the long side, but positioned in a pretty conservative manner overall. And that's because the economy, mediocre at best, the fiscal cliff is looming. And to write all that legislation in 2 months is a big challenge that I don't think they're going to be able to do. And I think it's at some point John Boehner will acquiesce and taxes will go up on the people over $250,000. And the bull market's not a brand new bull market. So those are the reasons why I'm positioned the way I am in the big picture. And I have all this income coming in. Municipals have been doing very well because obviously people are shifting to tax-free income. So be flexible here, but also don't overtrade. Overtrading can lead you into trouble because just when you think you know it and you got it figured out, it's going down because of X, Y, and Z. You could have one comment, one rumor, one whatever that has what they call a rip-your-face-off rally, and it just shoots up. So take advantage of that, but at the same time, don't get overly committed and to only see things continue down further. So as it stands right now, again, short term, I think that we may have a little more downside to go before we see that inflection point where it's a big, overwhelming panic, and that would lead to a much better bottom. All right, folks, have a great day. We will talk to you soon, and I am off to go get some medicine for this throat.